Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet. All Bitcoin's going to be erased.
Bitcoin's the best crypto out there.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero. We have a great episode for you this week. Lyn Alden from Lyn Alden Investment Strategies is our guest. Been a big fan of Lyn and her work for a long time. We'll talk with Lyn about the macro and policy landscape, how Bitcoin's fits into the macro stack, how investors are positioning given the future of Bitcoin's role in the economy. Talk a lot with Lyn about the Fed and her views on Jay Powell's job and how the Fed and Bitcoin interact and what we're likely to see in the future there. We'll also check with our good friend Beimnet Abebe from Galaxy Trading, as always, to talk about markets. Bitcoin on the verge of a new all-time high as I record this on Wednesday. You can see over my shoulder, 122,640. I believe the all-time high is 123,231. So we're very, very close. ETH also having a huge run. We'll talk about both of these with Beimnet in a minute. And before we get to that, I need to remind you to please refer to the link to the disclaimer in the podcast notes and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Man, really an exciting time in markets. A lot of crazy stuff happening. It's not a sleepy summer. It was not sell in May and go away. You had to stay engaged, and we have. So let's get right into it with Beimnet Abebe. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome to Galaxy Brains.
Thanks for having me.
What a day, what a week it's been. It's quite an exciting one. We're
Absolutely.
seeing a lot of movement. I was looking today at the Ethereum price in particular, which is up 120% since June, 260% from those April bottoms. That's 3.5x. And, still has not broken the all-time high, which, as you know, I know the audience will know I'm an avid Bitcoiner in general, between the two. And Bitcoin has made repeated all-time highs this year, but very notable move. It's hard to ignore on ETH.
Yeah, no, I think it's all the market is focused on for the most part, or it's gotten a large portion of mind share within the crypto community, rightfully so. The hottest thing in crypto right now are these ETH treasury companies, SBET, Bitmine. They're continuing to sell shares into the open market to purchase ETH. I think Bitmine on Monday upsized their at the money offering by something on the order of like $20 billion.
Yeah.
And they still have a pretty healthy MNAV. And so, I think the market is kind of getting ahead of that flow in terms of the ETH price action. And, you've seen a lot of speculative longs come into the market. To give you an idea, like there are days when, ETH trading volume is like on par with Bitcoin, sometimes over.
Which is like 20 to 40 billion and stuff, right? Like
more, yeah. And to give you an idea, like I think Bitcoin OI across all venues on futures and perps is something on the order of like $80 billion. And ETH has ramped up to 60 billion.
So way above its market cap ratio.
Correct. So you're talking about a $20 billion difference in OI versus like a $1.9 trillion difference in market cap.
Yeah.
And you've seen funding rates become very elevated, particularly in ETH and a handful of, ETH-related alts.
So it's costly to be long right now because everyone is crowded.
It's crowded.
Yeah.
Right? That isn't to say that it can't get more crowded.
Right.
Right? Like just because something is overbought doesn't mean that it can't be, more overbought.
Hasn't like the S&P been overbought for like months at a time, and it's like very frequently.
Historically, it has paid to buy all-time highs in stocks.
Yeah. Right. So anyway, to your point, it can go higher.
Yeah.
And I think that certainly wasn't my point to make that like, has it gone too high? I think it's just hard to ignore. I mean, a 3.5x since April, that's 4 months. That's a story in any market. Obviously, that was from an extremely low base.
Yeah.
But another data point is that the last 4 weeks, the ETH ETFs in the U.S.
Inflows,
have had more inflows than the Bitcoin ETFs.
Yep.
Which had never been true. They'd never the 5 weeks ago they were the largest inflows ever for the ETH ones, still just slightly at over almost 2 billion, and still just slightly lower than Bitcoin. But the prior 4 weeks, including this week, we're recording on Wednesday, so we only have Monday and Tuesday's numbers. ETH flows are outpacing the Bitcoin flows. I mean, in fact, 4 weeks ago, ETH flows were almost 2 billion, while Bitcoins were like 250 million.
Yeah.
So we're talking about like major discrepancies. And then during the pullback at the end of July, Bitcoin ones had significant outflows, and ETH still eked out an inflow. So like, there's a little bit of a rotation happening, no doubt, or has been happening.
And you can see that in the ETH BTC chart,
Yeah,
right?
that's
Like
right.
it clearly bottomed, and it's up a ton over the past 2 months.
Got down to like 0.017
Yeah.
or 0.018. I mean, I think I had a meme that was that TV show 1883.
Oh,
I
yeah,
used
it's a great show,
ChatGPT.
great
It
show,
was
by
at
the way.
like, I got a screenshot of when it was at 0.01833,
that's
and I
good.
used ChatGPT to make the main character's face on the movie poster Vitalik's face.
Oh, that's
But again, like that basically was the bottom, at least for now. I mean,
Yeah.
everything can
no.
change. but,
I mean, ETH
yeah.
is having its institutional moment.
I mean, there's
right
clearly
now.
a wall of money
Yeah.
on these treasury companies and other speculators, as you said.
Yeah.
You've got to think some of that starts to relax. Not necessarily the treasury co's, but the speculators as it approaches and gets to. Right now, we don't have a block clock for Ethereum and never will. But it's right around 4,700. The all-time high from 2021 is like 4,867 or something like that. 4,867, I think, my recollection. So they're very close. A lot of people, you have to assume, we're closing that gap, buying the tariff liberation day dip on the assumption that it was just too low, and surely it has to get back there. But as it gets there, right? I mean, it's been 4 years since ETH was in price discovery.
Yeah.
So no idea what happens then.
I think a breakout, like a confirmed, valid breakout.
Yeah, flipping that all-time high to support.
We'll see some pretty significant follow through.
Yeah.
I still think it's an under-owned asset, broadly speaking. Just if you think about market caps, like $400 to $500 billion versus like $2.5 trillion in BTC. So I think there's room to run. Before ETH BTC broke down, right? Like the ETH BTC relationship was pretty like constant in like the. Maybe I'm thinking about it in like the 0.5 region.
0.5 to 0.7 for all of like 21
Correct.
in that
and
region.
So, I think you could see a case for it going back up there potentially. But, I think to your point, there's a ton of digital asset treasury flow that hasn't come into the market yet.
Including from Bitcoin.
Including from Bitcoin.
Yeah.
But if you think about ETH just having a smaller float, right, and being a smaller market cap, like $1 billion into ETH will move price a ton more.
Right.
And moving away from ETH, there is a huge wealth effect from prices being at all-time highs essentially, and you're seeing that in the alt complex. And Solana's had a pretty decent run over the past couple of days.
200 I saw, which is. What is its all-time high? I'm recalling like 220s, but I think there was a wick. Yeah, there was a big
during
wick.
the Trump.
Like Trump
meme
inauguration.
Coin. Yeah.
Yeah.
And so there's room to run there. And you still have plenty of catalysts to come, right? Solana ETF, more Solana treasury companies,
all the tokenization stuff. One that's interesting. I know Tom Lee's been talking a lot about this. One of his theses on ETH had been the Genius Act and stablecoins, and I think there's some truth to that, no doubt, and that most likely Wall Street will build on Ethereum and its ecosystems. But for example, we just saw Circle announce they're building their own L1 blockchain.
Yeah,
right. Like that's the stablecoin, the U.S. stablecoin issuer.
And Tether has Plasma.
Tether has,
and there's Tron is pretty active.
So
in
it does make me, not that there aren't other catalysts, but like that one, I'm really not quite sure. And by the way, Solana and Tron have significantly higher stablecoin velocity, and ETH does have a plurality of issuance, but it doesn't have a majority. And most of the ETH stables, I believe, are sitting in DeFi. Right? They're not actually. It's not really used there.
Yeah. So
depends what you think stables will be used for. Will they be interbank transfers or medium of exchange, or will they be like settlement asset? And like ETH does well with stables as DeFi asset, but not so well for payments the way the others do. It's an interesting thing to think
No,
about.
yeah. I mean, the whole concept of value accrual back to ETH,
Also,
we
big
can
debate.
we can
Big
spend a
debate.
lot of time on that. But I do want to acknowledge that just because a bank is involved in ETH and uses ETH doesn't mean that they're going to hold a ton of ETH
Right.
on their balance sheet.
In fact, that goes to part of the value accrual question. Fees are so cheap, particularly on these L2s. The L2s, we were saying, I think Coinbase has only paid in all of Q2 base, their L2, Ethereum rollup, has only paid $443K in fees to the L1 to transact and confirm their blobs, as they're called, while extracting or charging its users on base nearly 15 million. So like that margin of like they're making 15, but they're only paying $500,000 to ETH. It's not quite the value accrual I think people hope. So I totally agree. I mean, ETH in some ways through its if you use these roll up L2s and you call that scaling, like it's scaled so well that like you barely need any at all to use the thing.
Yeah.
So it's a question.
Yeah, no. I mean, underlying all of the price action, you've had over the past couple of weeks is just kind of a return of animal spirits, a
little
return
bit of a catch-up trade.
of, I'm not going to go as far as to call it irrational exuberance, but there's definitely a lot of froth in the market, right? You have Fed policy that's really easy. Rates are rallying a bit further today. You've got fiscal that's incredibly supportive of
You've been talking about that.
of the economy. You have one of the hottest IPO markets I've seen in a while. You've had a number of very successful crypto IPOs.
We're getting close to Bitcoin all-time high here over my shoulder. Just sorry, my senses. No, you're right. You're right.
And you've seen crazy things like these digital asset treasury companies trading at very aggressive multiples. And there's a ton of vaporware in crypto that has multi-billion-dollar market caps to it, and it's generally been well supported. And so there's a lot of exuberance in this market, and if you're an investor and you're really comfortable going pretty far out the risk curve, like crypto looks pretty good, especially like ETH
And
right now.
well supported by the government policy.
Correct.
And very,
Yes.
very almost no chance, at least in the next 3.5 years, that any material like negative government action happens, at least in terms of prices. There are some interesting areas that we've talked about BSA and things where the government's not really bending to what crypto wants. But in general, for stuff that's supportive for prices, seems pretty safe. I would just talk about Bitcoin a little bit here, and then let's finally talk about CPI basically, because you are a macro guy, and then there was some data, but it's not super consequential. That's why we're talking about this. A lot of Bitcoin company treasuries that have been announced and not yet deployed, as far as we can tell as well.
Yeah.
So I think probably nominally a bigger wall of money, assuming it does get raised and does consummate, and these, in some cases, like SPACs do merge and all of that stuff, like probably a materially larger wall of money publicly stated to want to buy Bitcoin than ETH, but again, a much larger, more not so much liquid at the moment, but much larger asset than ETH. And so that's some of the discrepancy here between the two. But still, I mean, almost none of the announced net new ones, surely Sailor, surely Metaplanet, they're in the market, but like all of the 50 plus that we documented in Will Owens' report, almost none of them have actually deployed yet either.
Yeah.
And that's true across all of these digital asset treasury companies. Most of them are announced and not yet deployed, despite all of this price action. Most of them.
Yeah.
Which is crazy.
So the question is how much of that's like baked into the market, and realistically, you can't 100% bake that in until the flows come.
It's like we talked about with ETFs.
And so, yeah, I mean, it's a market where the path of least resistance is probably still higher. My only concern is I do think that, when folks get back from Labor Day, they'll be like, okay, we just had this spectacular run in risk assets. Vol's pretty low, very, very low. Like Bitcoin vols, like at the money, are like 33.
That's so low.
VIX is on a 14 handle and change. Credit spreads are super tight. And the interest rate curve is pricing very aggressive cutting path, and so if you see a reversion in that, that's probably not good for risk. And so I do think that my timeline, which I spoke about
You did.
2 weeks ago, is kind of like right around the start of Labor Day. Once folks get back,
You
like
look
I
for
think
some stagnation or pullback. Yeah.
correct.
Yeah, you said I think it was about 2 weeks ago. You said, and rightly, you weren't you didn't say even Labor Day then, but you're right. It feels right. You basically said probably higher, but then probably some stagnation
chop,
or even pullback
Yeah.
at some point before the end of the year.
Yeah, and then you'll get kind of a resumption of the trend higher.
Yeah, who knows?
Santa
End of the
Claus
year tends to
rally,
be pretty positive.
October, November.
Yeah, I think
you
over the
go
last
up.
10 years, October is Bitcoin's best performing month.
Yeah.
And I didn't go back to 14 years because there was a 500% rally in 2013 in October.
Yeah.
But yeah, since 2015 and 17, October, November, December have been very positive for Bitcoin almost every time. Only 1 or 2 years where it was negative.
And October for stocks is one of the best months.
Yeah, so but it does feel. I agree. I mean, you're stretched here a bit. It makes sense.
Yeah, I mean, funding is elevated. People are gone super out the risk curve in terms of what they've invested in. But structurally, the bull market's in place.
Yeah.
And if you're a long-term investor.
And same thing with
dips are there to
CPI,
be
right?
bought.
No big bad surprise with inflation at the moment.
No. I mean, you had. Well,
It's still elevated, though.
It's too early to tell on the inflation stuff.
Yeah.
You had a 0.3 print on the core CPI number.
Which is month over month.
Month over month.
Yeah.
Right. And the annual number came in at 2.7% core CPI.
Still
so you're
high.
still high, above target, and you've only you haven't seen the full effect of the tariffs pass through into prices.
Or
I think
the big beautiful bill spending.
correct.
Yeah.
And the wealth effect from all these assets going up
Right.
in value.
Right.
And so, I really do think.
Close Zillow, people. Get that Zillow closed, all right? Don't jinx us.
But yeah, so I do think there's a pathway for inflation to surprise, higher over the coming months. But again, if the Fed's committed to cutting because of various other factors, including, concern for the labor market and political pressure and, some other reasons, inflation can be very sticky and we can still be cutting. But yeah, I'm
And
definitely
risk
worried.
assets can still perform well
Correct.
with inflation.
With inflation.
Yeah.
In fact, they do perform well.
Right,
They,
that's
they
right.
are the better
That is-
inflationary
They
hedge.
actually usually are inflation.
Yeah.
Or you see it different.
But yeah, I mean, I think I read an article yesterday saying that only 20 some odd percent of the tariffs had been passed through to consumers so far, and that it's likely to go up to somewhere in the ballpark of 60 to 70% of the tariff pricing, hitting consumers directly. And so you still got a long way for that. And most estimates are for that the real impact of tariffs, you won't know for sure until another 6 months forward.
Yeah.
So there's still time for inflation to surprise to the upside.
Yeah.
And, you still, even though there are some cracks in the labor market, it's still pretty tight. You're talking about a 4.2 unemployment
Not
rate.
bad. Historically quite good.
Really not bad.
Right.
So, we'll see. But it's definitely nice to see crypto trading well.
I mean, we are very, very close to Bitcoin all-time high as we record this on August 13th here in New York. Beimnet Abebe, my friend from Galaxy Trading, as always, thank you so much.
Thank you for having me.
Let's go now to our guest, Lyn Alden, founder of Lyn Alden Strategies. Lyn, thank you so much for coming on Galaxy Brains.
Thanks for having me. Happy to be here.
Yeah, I'm a big fan. I think our audience will know of your work. You've written. You're a great writer, by the way. I love reading your writing. As someone who writes professionally, I've always enjoyed your writing. But I think most people should know that good writers need to be good thinkers, and you are one here. So instead of writing, I'm going to see what you can teach our audience today about your theses. You've written a lot about fiscal dominance, and I think we're at a particularly notable milestone in fiscal dominance, particularly with the White House exerting sort of unprecedented pressure on the Fed. Just maybe as it relates to the Fed, we're seeing just this morning, we're recording here on August 7th. I saw that the White House now favors Waller. Somebody reported as maybe the next chair of the Fed. What are your thoughts on Trump's influencing of the Fed in public, and what does that mean for fiscal dominance?
Yeah, so basically, fiscal dominance in general is when fiscal policies start to matter a lot more than monetary policies. And more specifically, when you get to a very high debt level, public debt level, so that even monetary policy decisions kind of stop working the way that they normally work. And the reason for that is their primary reason for raising and lowering interest rates is to try to either encourage more credit creation, more borrowing, or to try to slow down credit creation or borrowing. And that works in, say, for example, the 70s, when if you look at where money supply growth was coming from, it was primarily from bank lending. And so interest rates had a really big lever there. The problem is when bank lending is not that big of a deal. It's kind of on, if anything, it's muted right now. And most money supply, like during the stimulus period we went through a couple of years ago, is from monetized fiscal deficits. And raising interest rates doesn't really address that. It's pretty interest rate insensitive. And if anything, raising the interest rate when you have over 100% debt to GDP just blows out the deficit even more because they're paying more interest on their stock of debt, which flows out to the private sector and flows out to the foreign sector. So it puts the Fed in a really tough position. And so I wouldn't call I mean, a lot of things about Trump are unprecedented, but I wouldn't necessarily call his criticism of the Fed unprecedented, although it is rare. He did it in his first term as well, and then also it has come up in the past. It's generally uncommon in the U.S. It happens in certain other countries. Um, and the whole point of kind of Fed independence is you never really have a truly independent central bank. I mean, the governors are put in there by the president and the legislature, but they have terms that then they can act independently. They have their own budget for the most part, their own kind of source of revenue. And so they're kind of like the Supreme Court in a sense. They're almost like, in some ways, as cringe as it kind of sounds, they're almost like a fourth branch of government in some capacity. And so they can operate semi-independently so that you can't do things like, say, cut interest rates right before an election for specifically for political reasons, even though the Fed could choose to do that for economic reasons. So I think it's not shocking that we're seeing Trump put pressure on the Fed because, I mean, partially it's political, but also partially it is a debatable subject on whether or not they're handling interest rates and other policies correctly, because they're trying to kind of be hawkish, but it's not rapid bank lending that's causing the inflation that we've been seeing. And I like, there's almost no right answer for a central bank when it's the fiscal side, when the
Mhm.
problem's in the house, right?
Yeah,
Um,
it's in the house right now.
yeah, and so that's the issue. So I think it's a really interesting time in markets. I mean, anytime you enter fiscal dominance, things get kind of intense. And the only other time in U.S. history, I mean, the latest time we've been in fiscal dominance was like the 1940s, basically. So no one alive trading or investing was active back then. Um, and so, other than looking at history books or looking at what happens in emerging markets in other countries in more recent years, do we have somewhat of a playbook? And it's actually kind of it's kind of darkly fascinating, step by step, some of the things that keep playing out compared to the 40s in some sense.
Yeah, I think it is. And you're right, by the way. It's not only debatable, like the topic here, it's fair to debate. Congress is granted the power in Article 1 of the U.S. Constitution to mint the money and manage that. And they abdicated that or assigned it to the Fed with the Federal Reserve Act, of course. But it does actually, I've been making this point that, like, you want some level of independence so that the decision makers at the Fed aren't beholden to the 2-year election cycle, which was sort of your point. But it is reasonable for the people to criticize the central bank, right? The power of the currency does lie with the people. Technically, that was a huge part of the U.S. Revolution, was bringing that back. Like, is there a risk? Do you think, like, literally, like, is there some amount of, like, credit basis that is expanded here, some debt amount that is not being bought by us, that's causing rates, yields to be high because of the fight against independence that Trump has sort of been lately unleashing? You know what I mean? Like, does it cause a lack of confidence?
I think around the margins you see that. For example, there were some actions when I don't know if it was a trial balloon. I think that's a reasonable theory. When the White House looked like they actually might try to remove Powell, there were
Mhm.
some market reactions to that. They were quickly undone when it kind of went back. So there could be some residual premium in certain things, kind of an uncertainty premium
Right.
embedded in certain things. Probably the uncertainty premium around other areas of policy is bigger. I mean, I would say uncertainty around tariffs is probably a bigger factor right now than uncertainty around the Fed per se, because I think the market is probably correctly seeing that Powell is going to get through this term. Which so I don't think the market's placing a giant premium on that uncertainty. Um, and yeah, it is true that basically I think we saw, for example, Elizabeth Warren was criticizing the Fed.
Mhm.
Trump is one of the few things those two probably agree on.
I think he
Uh,
tweeted that too. That
yeah,
it is one of the few things they agree on. That's right.
yeah, and it's funny, and I think if you go back to the topic, like should interest rates be set centrally? Most people, if you ask, are you in favor of price controls? Like, should the government say what the price of bananas is? You would say no. Most economists would say no. And you say, well, should they set the most important price of all, like the price of credit? Usually short-term credit. They also technically can intervene in long-term credit. And it's like, should they be able to do that? I would say no. But that's the world we live in. And then the question is it being set well?
Right. I think there's a lot of. I mean, you can always debate that, and I think for my money, I think Powell's done a pretty decent job. Maybe you can expand with that as a stipulation that I'm positing here, because I think the other point that you mentioned that is really interesting to me is this rock and a hard place when they've, they should be turning back and saying, Mr. President, like you need to cut the fiscal situation down in order to get inflation down at this point. Like it has Powell done a good job for the role that he's in?
So I would not say he's worse than any of his predecessors. If you think, like, would I rather pick any of his predecessors to be running things right now than him? Probably not.
Right.
I think he's been better at articulating what he's doing. I think he is. I think at the end of the day, he's trying to do the right thing as he sees it. Um, I think there's valid criticisms. I think they were ignoring the risks of inflation, and then in some ways then over-indexing to inflation, almost like playing catch up for the prior mistake. And I think there are banks that kind of got impaired unnecessarily from some of that.
Hmm.
That kind of whipsaw that you did when you had the central policymaker just kind of going 180 degrees like that. Um, Another criticism I think is you could say that he during the heart of the economic crisis in 2020, he specifically called for more fiscal support. So he made a rare comment by the Fed about fiscal policy.
Hmm.
Um, and yet, when we got inflation from multiple rounds of fiscal policy, which I was actually writing about at the time, saying if we get a lot of this, we're going to start to get actually inflation most likely. Um, uh, he has been silent on that part. And you would go back to the normal talking point of the Fed is not really supposed to comment on fiscal policy. So it's kind of like that asymmetry that I
Yeah.
think he's been criticized for. So I think if I were to say, if there's one thing he could be doing differently, it's being more transparent about the fact that the current fiscal situation is making their job harder and more uncertain. So I wouldn't go to, I'm not really, I don't think the problem is who's running the Fed right now. I think the problem is the broader situation.
Yeah, it is, and it's. I think it's pretty unlikely that any Fed chair would have handled any of this much differently. They are attacking their central banks around the world. I saw that the Australian central bank's been under like a review for their inability to forecast the inflation, right? And obviously here, Secretary Yellen at the time had said it would be transitory, right? And they were just obviously wrong. It is ironic that you point out that he intervened to basically say print more money and what ultimately cause inflation. But now that people want him to speak up about the debt situation we're in, he's too independent to talk about it. It's like we only seem to the damn ever only seems to break in favor of more spending, right? Like people don't. You have a phrase that you like to say for that. Like, what is going to stop that in the future?
Yeah, I think nothing stops this trade. Yeah, and that basically for the next 5-10 years, any sort of investable time horizon, I think the U.S. fiscal deficits are going to be very large. Historically, when you look at this kind of situation, when you get to over 100% of GDP in the public ledger, so the problem there is the path dependence that we got here. First, there was and we saw this back in the 30s and 40s too, and 20s. So in like 1920s, you had the big private sector debt bubble. Then it all blew up in the Great Depression. They kind of rotate a lot of that debt onto the public sector and then really kicked it into overdrive during the 40s, during the war era. And then a combination of inflating it away and productivity growing out of it, basically bonds underperforming almost everything else. They took care of the problem. So they kind of like move where the debt is and then kind of soft default over time. And that's basically what we're seeing the playbook happen as well. So in the 2000s, you saw the peak of the apex of the private sector debt bubble. First, there was a stock bubble, and then there was a housing bubble, which is the worst kind because that's leverage. Then it all blew up, and then we rotated things toward the public sector. And then when we had the next crisis, which was COVID, much like wartime finance, we treated it basically like a war, like a big disruption, printed a ton of money. Basically, bonds spent 5 years underperforming everything else. And the issue is that when you get to that high of a public, debt to GDP, there's really nowhere else for it to go. If an emerging market gets that indebted, they're likely going to default. They're going to restructure. Whereas if if the liabilities are in your own currency, you normally default through purchasing power, which is that bondholders get every dollar they're owed, and just those dollars buy you less stocks, less house, less gold, less Bitcoin, less usually less commodities and goods and services. Um, and that's what we're seeing play out. So there's the hard part of that whole thing is that there's really no simple way out of it because it's the result of multiple decades of decisions. And so you're kind of in that default scenario, but nobody wants to be responsible for that default. So everyone's deflecting blame. Everyone's saying it's not their job. Everyone's, it's challenging because there were decisions made 20, 30, 40 years ago that are playing out here, but no one's blaming them. They're saying, well, is Biden or Trump responsible for inflation? No one is saying, hey, maybe the Iraq war is contributing to inflation because that's where part of our debt came from. Or hey, maybe decisions decades ago around how certain of our entitlement systems are structured. Those politicians are long out of office, and we're dealing with them now. And that's kind of the whole thing of fiat is you can defer things long enough that those who made the decisions are not the one that ever have to deal with them.
Yeah, it's not like our 2-year-olds that are voting on this stuff either, right? Like they're the ones that will saddle, just like we're bearing the debt burden from our parents and grandparents, like they're going to bear it from us. And yeah, that is a structural inefficiency of our government in general, of our style of government. It's and it makes me wonder, like, this is where you could say like a benevolent strongman that can govern for decades is able to make longer term decisions, right? It's like a private company. I was just reading about how Cargill is this giant like food company that is private. It's one of the largest private companies in the world. And thus they can make very long-term decisions. And I used to work at Fidelity, one of the largest private companies in the world, totally private, family-run business. And they were much better at long-term innovation thinking than companies that I've seen. There are some great, obviously, public ones, but the quarter-to-quarter mindset, it's almost like we have that same problem in not just our government structure, but perhaps all democracies, right? Like it's much easier for China or Russia to take a long-term view, in my mind, than a government that's beholden to very frequent elections. It's kind of sad. I wonder if you could correlate them, fundamentally.
Well, I think that's true, but I think it goes in both directions, which is that if a authoritarian style government is wrong, they can also be wrong consistently for
That's true.
decades, and there's no really capacity for course correction.
Totally.
And so they can be right for decades or wrong for decades. And if you look at the numbers, I mean, basically, countries that have some sort of representative government tend to be outperforming on a per capita economic basis over the past 50 plus years than authoritarian style governments, with a handful of exceptions. And even the exceptions tend to curtail themselves in some way. Like China makes these top-down decisions, but then still has competition on the company level. So they basically say we want banks to lend more to car makers, but then out of all the car makers, it's going to be this big battle royale. So we determine what sector, and then they figure out who wins in that sector. That's kind of their approach. I totally agree with you that when it comes to a company, a long-term founder, generally speaking, there's a good precedent for them outperforming because they're thinking years and decades ahead, not quarters ahead. And the good thing there is if they are not the right leader, either they'll eventually get pressured to step aside, or their company will just become irrelevant, and those will go around them. Whereas in countries, it's not. They have basically a monopoly in some cases, and so that's the issue. So it's that classic quote where democracies, it's kind of like bad, but it's kind of the least bad thing in many cases that we have access to. And I think it's specifically the combination of democracy with a money printer. That's the real kind of combo that is brutal. Like if you have a constitutional representative situation, but then constraints on the money, where that kind of forces things to be transparent and more near term. Like we had our founding fathers talking about, at least some of them were talking about the irresponsibility of leaving debts to future generations. And yet that's what we're doing today, in large part because we have a money printer.
Yeah, you're totally right. It almost makes you wish that they had codified, an amendment to the Constitution related to like debt to GDP or something like that, because it feels very obvious that nothing stops this train because of with our current setup. But it seems like it could have been possible if you could have somehow shackled Congress on what it was actually capable of doing on the spending side. Granted, they'd probably have unshackled themselves by it from those shackles by now anyway. Let's go into Bitcoin. You pretty famously got interested at this point, probably like 5 years ago, I think is when you posted your first thing about it, if I recall. When was that? Yeah. How did you get interested? And was it this train not stopping that sort of made you find it?
So my first article was actually back in 2017, so nearly 8 years ago. But
Yeah.
that point, I was more interested. It was that point. It was kind of in that raging 2017 bubble. So I was like, I'm interested, and I had two main hangups. One is it was quite euphoric, and two, I still wasn't sure if Bitcoin's scarce, but I was still in the Bitcoin versus crypto analysis part where I was like, is the any sort of use case here going to fracture among 100 different coins, or is it going to be winner take all? And so I was like, okay, I'm interested, but it's euphoric. Let's wait and see. And then it did underperform, or the broader space, including Bitcoin, underperformed for the next 2-3 years from that point. But I paid attention during that bear market. I had heard about it before. I was always interested, but it just kind of wouldn't pay attention to it in bear markets. This time I did. And so I saw the block size war play out. And I kind of basically, the key factor was I determined that it has a network effect, that this is like a emerging communication protocol, a new standard that has basically won. And therefore, that not only is it valuable, it's not likely to fracture too far. And then it just became a question of price. And really, the trigger for me there, I was already kind of interested. But during the 2020 sell-off, it
March
kind
of
of
2020, basically. Yeah.
it behaved just like gold and silver did, especially silver being more volatile, where kind of everything went down in March, and then we had the Fed liquidity bazooka, and then we had the fiscal liquidity bazooka, and all these things started going vertical, and Bitcoin was doing the same thing. So it was April 2020 where I said, okay, now I'm in.
Yeah,
And so I've
this is
been in ever since.
what I was thinking of is it was,
Yeah.
and you beat Paul Tudor Jones by a month. But I remember at the time when you came out very strongly in favor of Bitcoin, it was like it was a pretty watershed moment. You were one of the first and smartest like macro people to recognize Bitcoin's place, and your point too about the fracturing. I frankly, it doesn't surprise me as a long time supporter of Bitcoin and owner of Bitcoin, but it is sort of still kind of surprising that 50 million altcoins have been created in the time. Maybe, I mean, even more. It's really frankly impossible to even count them, but and still, even still 15, I guess now 16 years after Bitcoin launched, it's still like, even by the naive metric of Bitcoin dominance, it's still 60+% of the entire value of the entire space, despite all of the IBM going to put tomatoes on a blockchains and all of the smart contracts and all of the DeFi. It's still well more than half, and frankly the number is even higher for other reasons. Like that network effect really does exist. It really is real.
Yeah, when you exclude stable coins, and also when you take into account liquidity, so like
Right.
actual, like kind of liquid market cap, like it's even higher.
Yeah.
And that was basically that was kind of the final observation I needed to say, not only does this have value, because basically the question is, can digital scarcity have, is it truly scarce? Can it have value? Even if Bitcoin's scarce, will it fracture? And the final piece was, yeah, network effects matter. Liquidity is self-reinforcing. Security is self-reinforcing. And the ecosystem of apps and even hardware building on top of it is self-reinforcing. And just like how USB, when it gets in every device in the world, that's pretty self-sustaining, and it can even upgrade gradually over time. So that's kind of the last straw I needed. I was lucky that I have an engineering background, so that weird blend of engineering and macro is kind of, I think, what drew me to it a little bit before other macro people, not as early as some of the tech people, but a little earlier than other macro people.
Mm-hmm.
And like, for example, my part of what catalyzed me to write that 2017 article, even though I'd already heard of Bitcoin, I was never really opposed to it, just wasn't big enough to really be on my radar. but I was basically the overseeing the engineering finances of a facility in 2017, and we buy a lot of GPUs at the time, and like all the GPU prices like doubled, and I was like, why is this happening? And like one of our entry level engineers was like, oh, that's the Ethereum bubble. I'm like, what's an Ethereum bubble? So I'm like, clearly have to. So that was like the early stage of the 2017 run. That was like spring or
Yeah.
whatever, and
Yeah.
then so I kind of did a deep dive on it, and so by later that year, I was finally kind of a little caught up on what's actually going on.
Yeah, it's super. That was a crazy time, and in fact, one of the interesting things, CoreWeave, one of the biggest GPU, providers and data center managers in the world, they were an Ethereum miner. That's how they started, and there were many, and now obviously, Galaxy's doing this too. But just as an aside, with the AI like boom that's happening, people are like, oh man, we need these. If only there was somebody who'd been building tier 1 data centers next to massive energy sources. And it's like, oh, Bitcoin miners have been doing that. A lot has changed and grown. It's really quite crazy. I wanted to ask you now, so we've talked a bit about fiscal dominance in your sort of the overall view of where the government and debt and spending are headed, and you've obviously done a lot of work on how Bitcoin plays its role. You mentioned how it traded in 2020. Like, are we going to see? I get asked this all the time. They're like, "Oh man, like someday." There was a day, I think it was on Monday or Tuesday, markets were all down. Everything was down on Tuesday, and Bitcoin was down, but gold was up. And people are like, "Oh, it's not trading like gold." And I'm like, "Well, it's a pretty short, like one day example." But where is Bitcoin going to go long term, in your view, given the situation in markets and with government debt?
Much higher is the short answer. I mean, right now, I mean, Bitcoin's about the tenth of the size of gold, and it's been around for 16 plus years instead of thousands of years. And there are multiple periods of time where, I mean, people are always concerned the government was going to like ban it or make it add frictions, get in its way, and so that's part of why it never really had like a safe haven perception. Even among people that are deep in the rabbit hole of understanding it, they're like, you can self custody your own money, so they treat it as a safe haven. But in a price action standpoint, big pools of capital wouldn't treat it as such. Um, Being still volatile and still fairly new, I still think it has some ways to go before it reaches that level. Um, Partly it's the way it responds to crises. I pointed out, and I've had debates with some institutional people on this, is that it's mostly depends on is the crisis pro liquidity or anti liquidity. So,
Mm-hmm.
for example, the March 2023 regional banking crisis, Bitcoin responded quite well after like the initial few hours because the market's immediate reaction was, "Oh, we're gonna print money for this," and so that was like a pro liquidity crisis. Whereas other types of crises where you get, say, an oil spike or a dollar spike, something like that, even though probably the answer down the road is going to be money printing, it's not necessarily like next day, and so you tend to get a sell off in things and Bitcoin's like the strongest correlate with global liquidity compared to every other asset that I've studied. It's not the only variable that matters for Bitcoin. There are other things. I mean, election outcomes, for example, regulatory changes obviously had a big impact on it. Technical details, just idiosyncratic aspects to the asset itself. But it happens to have a pretty strong liquidity correlation, so that's how it tends to respond to crises. Whereas gold has a hybrid of a liquidity correlation, but also that safe haven status that Bitcoin is, I think, getting there but not there yet. So I think when it gets bigger, more liquid, more widely held, when it's just been around institutional spaces for longer, I think it can start to bridge that gap and trade more frequently like a safe haven.
Yeah, you wrote with Sam Callahan, a friend of ours, and who's appeared on this show, about that in 2024. I guess it was almost a year ago now, actually, but seems pretty recent. Bitcoin is a global liquidity barometer, and you found that 83% of the time in any 12-month period, the highest, Bitcoin moves in the same direction as global liquidity. Is that chart with the M2 chart with the delay, or that people like to show the correlation? Is that what you look at for global liquidity, or like how do you think about global liquidity?
So there are multiple ways to measure. I don't like those charts because people pick the time frame
Yeah,
arbitrarily and then just change it when it doesn't
you just
play
move the
out.
lines
So
around.
yeah, we didn't have any of those charts in our article.
Agreed.
There,
Yeah.
there is a correlation between Bitcoin and global M2. So global M2 is interesting because it takes into account broad money supply from multiple major countries, but then it's tied to dollars. It's basically translated back into dollars, which is relevant because dollar strength matters because there's so much dollar denominated cross-border debt. So when the dollar weakens, that's generally good for global liquidity because it's like if you take out a mortgage in pesos and then the peso goes down, that's good for your liquidity profile. That's what happens to countries when they take out dollar denominated debts. Now there are like more proprietary things you can do, like Michael Howell of Cross Border Capital has more sophisticated liquidity measures. The problem is then they're not very transparent. Um, and so for that article, we wanted to give something that's just it's open. People can check it; they can check it for themselves. We point out instead of trying to fit to say, if liquidity does this in 3 months, here's what Bitcoin's going to do in 3 months. We weren't getting that granular. The smallest time frame we used was 6 months, but we also looked at 12 months rather than trying to cherry pick specific time frames. And generally speaking, just liquidity is a really big impact on Bitcoin for a couple reasons. One, liquidity tends to correlate with risk on assets, or at least assets that are treated as risk on. So that's Bitcoin equities, things that generally have volatility. Whereas gold and bonds, being more safe haven type assets, don't have a perfect liquidity correlation. If anything, sometimes they're inverse. And then also, but unlike stocks, if you take Bitcoin versus stocks also have the earnings component. So you could have an environment that's good for liquidity but bad for earnings, like kind of a stagflationary environment, and so stocks might not do well, and yet Bitcoin is more purely because it doesn't have earnings. It's an alternative money. It's more trading on that liquidity, and so that's I think by almost like by process of elimination, it has the most pure liquidity correlation. Um, and what we generally found is that the exception, so the 17% of the time that it doesn't trade well with liquidity, that tends to be from starting points where Bitcoin is very hyped up. And we used market capitalization compared to realized value or on-chain cost basis. Basically, when there's unusually large dislocations, kind of top of cycle stuff, that's when almost like for the next 6 months, if there's any sort of cracks anywhere, liquidity could be fine, but Bitcoin is just falling from such a hype level. So if you look at kind of those, just one is euphoria in the Bitcoin space, and two global liquidity. If you combine them together, you're likely to at least do pretty well and protect your downside when trying to forecast probable price directions.
Yeah, I guess if you take it from the top of that MVRV, it's a matter of selecting your window. I think that makes a lot of sense, and sort of stemming from that, in that piece you talked about, and you have in your latest piece. Let's talk about this, the one you just put out. You just put out Rise of Bitcoin Stocks and Bonds. You expand on this idea a little bit in the context of these pubcos like Strategy and Metaplanet, many of them now. But you talk about Bitcoin as having tactical convexity. I'd love if you could explain what you mean by that and how that makes Bitcoin really an interesting. You talk about it giving you optionality, like it's portable capital, and it has this really interesting like convexity in the sort of right-sided upside. Can you explain what that means?
Well, mostly what I focused on the article is trying to basically justify why these companies exist and why they do deserve, in normal market conditions, some degree of premium over NAV. And so the first reason was that they took Bitcoin and put it in an environment where it really wasn't before, which is basically stock managers, bond managers, and all this. And then the second layer of kind of why they exist is that they have access to better types of leverage than most people have. And when you combine longer duration leverage with an asset that has a lot of upside potential, that's kind of rocket fuel as long as it's managed conservatively. I mean, leverage it adds convexity in both ways. And so in this capacity, it actually gives something to institutional capital and to some extent retail capital, that doesn't really exist in other packages, and therefore people will generally pay some at least mild premium on a pretty sustained basis for that. You also see, and we talked about fiscal dominance earlier. When you see like a country, like let's say Turkey or something, have a currency crisis, you'll see a lot of companies, like if they can help it, they'd rather own dollars and then borrow any amount of lira
Yep.
that they can get their hands on, or buy gold and short lira and all that. And so then there's usually restrictions on like credit creation. They'll say you can't, banks can't make loans for these industries or these purposes. Then you get really top down management of the banking system, and it becomes kind of a negative flywheel.
Mhm.
And so we kind of see in developed markets a slow motion version of that, which is you have an asset that is, kind of truly scarce and is going through some degree of tech adoption. If you can attach a fiat currency short to it, and do so conservatively in such a way that you're not caught out by Bitcoin's cyclicality, it really is a value add, especially because certain types of leverage, like you need capital structures or you need scale in order to do that leverage. Liquidity also matters. So having an active options market, having enough volume to do all that is relevant. And so that's, kind of my case for why these companies make sense, at least when bought at appropriate prices.
Yeah, and a lot of people have asked if and wondered, I think, if this is like if the treasury company movement ends up being a bubble and somehow pops or something, would that create systemic risks for the underlying asset, Bitcoin? What are your thoughts on that?
I would say not at the current time. I can imagine scenarios where it is, but right now I don't consider it any more dangerous than prior cycles. So it's like one of those things. If you ask, was Bitcoin a bubble in 2013, 2017, 2020? Kinda, but only in the cyclical sense. It was a local bubble on top of a structural thing that's real, that's really growing, and actually a new thing that matters. And so I certainly think that you can have a bubble in Bitcoin treasury companies. I think we've had little local ones. I mean, generally speaking, when MicroStrategy would trade well above 3 times MNAV, and all on Twitter X, that's all you see people talking about in the space. That's like a local bubble that sets you up for like at least a 6 month, consolidation correction. Had a couple of those. We've had Metaplanet at pretty high levels. It happens. By the time this cycle's done, I wouldn't be surprised if there's maybe an oversupply of less than stellar quality treasury companies coming to market. I mean, we already see this happening in the altcoin space now. Altcoin treasury companies, I think even like NFT treasury companies, or treasury assets, and I think there will be a washout eventually, and that can include some Bitcoin treasury companies if they don't manage their debt well, if they get over their skis. Um, if they don't have protections in place. But it won't be a fundamental bubble. It'll just be over enthusiasm. And the terminology I've used before is that Bitcoin needs upward volatility to reach its potential. That's how you grow from a zero network size to a multi-trillion network size. Anytime you have upward volatility, you're going to get enthusiasm and leverage. So you need, just inevitable, you're going to get periods of downside volatility. Um, and we saw that last cycle. I think we probably will see it to some extent this cycle. So far, at least, it's generally speaking more sophisticated actors attaching leverage to it. But that doesn't mean that they're always right. So some of them I think will get caught out. I would eventually like to see more companies with cash flow have a treasury strategy. It's almost like Bitcoiners were waiting for companies to follow MicroStrategy's lead and start adding Bitcoin to the balance sheet, and so few did that Bitcoiners just started making companies to do it. But I would like to see those two kind of come together, where we see a greater number of companies with cash flow, decide to add Bitcoin to their balance sheet, or for new ones to pop up that have a more of a goal of getting some cash flow.
Yeah, I agree with that. It's kind of like, we have we wanted, Bitcoin for corporations. I'm thinking about Michael Saylor's conference I went to last year, and it was all about what you just said, the end of what you just said, which is, hey, you don't have to do what we're doing, but you should have some Bitcoin. And instead, we still don't really. I guess Figma just went public. They own it. They own a fair amount of Bitcoin, I believe, on there, something like $70 million, I think, of Bitcoin and ETH. But yeah, like, I don't know, Michael, right? He presented to, who did he present to? The Microsoft board or somebody? He did a pitch towards. Obviously, it was like almost unanimously voted down. What is the delay here? A lot of them are sitting on like billions or even hundreds of billions of cash that is losing value at like pretty, historically quick rate in the scheme of things.
I think it goes back to your prior point that when a company's not led by like a founder or a long-term CEO, they're more of just like a manager. They're looking a few quarters ahead, um, and uh, and then with Bitcoin, I mean, it's one of those things where the most successful companies will often look at it as the distraction. So if you're a Mag 7 stock, you're more thinking of how many tens or hundreds of billions of capex in AI am I going to have to do over the next 5 years? Bitcoin's just a distraction at that point. If you overcommit to Bitcoin and it goes down, then you look like an idiot. If you undercommit, it doesn't matter. I mean, if they put a billion into Bitcoin and it goes up to 10 billion, and Bitcoin's $1 million coin, that's a distraction for them because they're so big. So that's just kind of what's on their radar. I think the market that's more ripe for it is companies that like value stocks that are like profitable but like just not growing. And so instead of just always either buying their shares back or it's kind of slowly melting. Some of them have an asymmetrical opportunity here to buy something that would excite the market and be good for the balance sheet longer term. And then it just comes down to which ones have the vision to do it. We have generally seen, you'll see like these Bitcoin brokers report that a lot of small businesses add Bitcoin to the balance sheet, and that's because they have the situation where the founder just like either one or a small group of people own the company. They can do whatever they want. They don't have to go through 7 committees to make a decision. And so I think you basically need to see some value, publicly traded value stocks that are in that side, or you need to see the rise of new companies that are founded by Bitcoiners that come to market and enter more of those value or cash flow type of spaces.
Yeah, it's almost like just a natural growth and rotation. It's the same way that, like, the great wealth transfer that's been talked about for so long. Eventually, Bitcoiners, there are so many Bitcoiners and there will be more and more people who love Bitcoin. Like, adoption is growing up. So eventually, just naturally, there will be more Bitcoiners on all boards, corporate boards, and in all companies. It is funny though to watch, like, I think Apple has like over 100 billion in cash just like sitting there. And it's like, the real yield is they're losing money, even if it's sitting in the in treasuries or something. And I guess it's like maybe like corporate treasury, like they must have an annual corporate treasurers conference or whatever. And like just nobody's innovated for decades and like what those guys are doing. Basically, they're just, most of them are just running the risk averse playbook of like, have most of this in cash.
Pretty much. I mean, Apple's kind of an exception compared to Alphabet and others because they have a lot of cash, but they also have a lot of debt. So they're kind of in almost like a neutral dollar position, and they locked in a lot of long term debt, which is good for them because they could issue bonds cheaper than almost anyone else. And the funny thing is, I think ExxonMobil did the same thing where they had decent amount of long term debt, and then they had decent amount of cash, and they're almost like a inverse bank. Instead of like banks were caught out because they were like borrowing short at high rates, and they had lent long, and they were some of them were in trouble. Companies like ExxonMobil or Apple had borrowed long at low rates, and then were earning higher rates on their shorter term treasuries. So that's not the end of the world for them. The ones that like just have a ton of cash and like no debt or little debt, just a gigantic net cash position. That has basically been in melting ice cube. That's what MicroStrategy was in before they adopted the Bitcoin strategy. There's a lot of big ones now. They're retaining some optionality for the amount of like capex they are increasingly finding themselves having to do. So they actually, for years now, they kind of hit their peak collective cash levels and kind of gradually have rolled over as they finally find a thing to spend that cash on, which is GPUs basically in data centers. And so we'll see how that plays out. And I've made the case before that like one of the best products that like a company like Coca-Cola or Procter Gamble ever sold were their bonds. And that's partly what a corporation has done in recent decades to be so successful, and why big corporations have tend to outperform smaller industry is that they play the fiat arbitrage game, even though they don't really describe it as such. So a company like Coca-Cola will have tens of billions in debt, even though they've been profitable for like every year for like a century. And it's like, well, why do they have debt? And the answer is because they can. They can issue a 20-year bond at 2%, or at least they could, and sell it to the market, buy their own shares back, pay dividends with it, which is a better use of capital. And so they're shorting. They have like these long-term shorts on the fiat currency at rates that are way below the growth of money supply. So they do, and so companies have actually, I think, played that game pretty well. And just there's a bias against risk and volatility, which kind of makes sense for tens of billions of dollars or hundreds of billions of dollars companies. But I'm surprised we haven't seen a little bit more forward thinking. I mean, I think Meta's been in it. Like they have a position where they could have had some Bitcoin on the balance sheet, like Tesla, just haven't done it. That's a little bit surprising. So yeah, there's a little bit of a I think stagnation there that is pretty
Yeah.
inexplicable.
Let's talk before we wrap here. I want to ask you a little bit about the government and its crypto policy, and so I want to ask you about the strategic Bitcoin reserve concept also. But even before that, since it's even more directly related, is the passage of the Genius Act, the stablecoin bill. One of the big arguments that Secretary Bessent has made, the Treasury Secretary, is that it will create. I mean, he was citing a B of A study, but trillions of dollars of net new demand for our debt. Do you think, like, how do you view what what is the meaning of the stable? Obviously, it's stable coins can be better for payments than like traditional, I don't know, crappy dollar rails that are expensive or slow or old. But like they seem to be making a much more geopolitical, strategic decision and argument with stable coins. Do you see it that way?
Less than they do. I don't think it's entirely wrong, but I view it as less. So, for example, there was that city study, and the Treasury Secretary was citing it. So, in their study, they estimated by 2030 there'd be 1.6 trillion in stablecoins as a base case, with 3.7 trillion being their bull case, and the Secretary cited that number. But if you actually break down, they had a chart in that report, City did, where they had the different sources of where they expect, like what do they expect stablecoin supply to replace and eat into. A lot of times it's existing pools of capital that own dollars and or treasuries. So they expected, for example, some degree of physical banknotes, holders of those, to want to be in stablecoins instead. They also expected some people that are in bank deposits, either onshore or in some cases offshore dollar bank accounts, to want to be in stablecoins. But the way that currently works is those dollars are backed up partially by treasuries and partially by things like loans, and this just shifts it more toward treasuries if you own stablecoins that are backed by treasuries. Um, and so a lot of that is actually just eating from existing pools of capital that already own dollars and treasuries. Where it starts to create new demand potentially, I think, is a couple of capacities. One is that it's easier to get stable coins into countries at scale than physical dollars. And so there's like and I've spoken a little bit with Andy Constant about this. He's kind of brought up the point that there's a gray market premium or black market premium in many markets uh, for the price of dollars, because there's a friction in getting dollars by those that want them. And stable coins generally make it easier to get them. So it should, in theory, close that gray market, black market premium more so than create new demand, because that demand's already there, and it's just the question of can they get it. Now, the point you could make is that once you close that gap, it creates more demand because it's viewed as a better thing to get access to. In addition, stablecoins give you cross-border payment functionality that physical dollars don't in all those countries, which is particularly relevant for like smallish businesses. I mean, there are over 40 currencies in Africa. There are over 30 currencies in Latin America. If you're any sort of business that has vendors or lenders or customers in a cross-border sense. And imagine how many companies in the U.S. have customers that are not in their own state. Imagine if every one of the 50 states had their own currency. And so stablecoin balances can matter for that. So I do think that you know acknowledging and allowing for stablecoins does, in some sense, have a geopolitical role, but that's like a fraction of whatever headline number you're going to see, because it's only a fraction of that is actually kind of new, fresh demand for dollars and treasuries.
Interesting. Yeah, very interesting topic. I know everyone's trying to figure out the answer to this too. And by the way, even the government is trying to figure out how exactly this is going to shake out. I think also a lot depends on where the rulemaking actually comes. Treasury has, I think, a year from the signing of the law to actually establish all of the related rules, and then the rest of the issuers have a year to comply with them. So I think more is the impact of Genius is still yet to play out. Another big question, and you mentioned this, is what will be the impact on bank deposits? Like the ICBA, which is the trade that represents community banks, was vociferously opposed to this bill. They seem to think that this will cause, that everybody will start using stable coins instead of like the local bank of like, Paducah, Indiana or whatever, right? And I don't know the answer to that. I'm working on our own study of perhaps like a bottoms up analysis of bank deposits and what sectors or geographies or types of payment flow might be more likely to be adopted with stablecoins. But to me, I feel like most of this question, most people, even if you're a merchant and you're getting paid by your customers for goods and services, or if you're labor getting paid your salary, most people are just going to turn around and deposit their, if it's in stables, they're going to be depositing it back into a bank account anyway, most likely, is sort of I don't think there's going to be that many freaks like me who decide to self-custody their digital dollars. Like most people put it back into the fintechs and banks they already use. So I think some of those fears are overblown on the retail banking side.
I generally agree with you. I think that it's normal for them to be concerned because banking used to have kind of a monopoly on both savings, like liquid savings, and payments. That's kind of and lending. That's kind of what the collection of services banks did. And fintechs didn't really break that because fintechs are basically just layers on top of banks anyway. It's just the customer doesn't realize they're operating with banks, but they are through this intermediary. And what this technology actually starts to break that up more, which is basically you can have payment services that are just things that own T-bills that are unconnected to other types of lending or connected to other types of things, and then banks become more like optional to you in that sense. And so then the question was, well, where does lending come from in that environment if people aren't stashing their money in banks? But like you, I think that most people don't want to custody all of their own money. Some do, but it's just not.
Right.
Businesses, individuals don't want to, so they put it somewhere. Then the question becomes that bank runs can happen faster now because it's digital. We saw that with what happened back in 2023. Instead of literally a line of people trying to withdraw
outside the daily savings and loan or whatever, right?
Exactly. Yeah, with
just
an
like
API, you
withdraw.
don't even go to the website. It's just and now it's like your AI agent's going to do it for you. And so that's it. It changes how banking works to some extent. It challenges some of the fractional reserve model and liquidity assumptions that you have, because the whole point is you have illiquid assets and liquid liabilities, and you just hope you don't get called out, or that you can borrow from other banks or a central bank if you do temporarily get caught out. Basically, it increases the estimated liquidity threshold that entities like this need, which is not necessarily good for their business. But I think it's natural for that to be challenged because I think it was an artificial construct based on the technology that existed at the time. And I've made the point before that when you have fast transaction speeds, starting from the telegraph, but you don't have fast settlement speeds until Bitcoin, that's the golden age for banks. And now we're gradually kind of getting out of that era. And so banks go through a period of disruption. Doesn't mean that there's no such thing as banking services, but it just means the shape of banks doesn't look like it's going to like it did in 1980.
Yeah.
It's going to gradually keep shifting over time and primarily more toward higher liquidity estimates.
Yeah, I agree with that a lot. And I recall your analogy about sort of like the speed of the media versus the speed of the settlement. And the Fed Governor Waller, who I believe is in charge of payments for the Fed, he also made this point. He said, "Hey guys, banks, it's going to happen." I forget the exact quote. It was at a roundtable like within the last month, maybe a month ago. Hey, banks, like we're not here to protect you. Like, sorry, he literally said that in relation to the adoption of new payment rails like stablecoins. So people, I would say also like this government is one of the least pro-Fed governments that I think we've had in at least recent memory. Not that they're anti-Fed necessarily. I mean, putting the stuff we already talked about with Powell aside, but even like the Treasury, like they're not like particularly, not only the Fed, but even particularly pro-bank. I mean, Genius Act is going to disrupt banks in some way for sure. And everyone was fine with that. Veto-proof majorities in both houses to vote for it. That'll be very interesting to play out. And before we finish, I want to ask you about the strategic Bitcoin reserve. We talked a lot about how companies and also individuals, how Bitcoin is useful in this fiscal dominant era that doesn't seem to be changing. The government can't be like short dollars and do the trade that MicroStrategy is doing quite well with government. So right? I mean, they're issuing the dollars. So what is do you think the strategy here, assuming that they end up buying and doing what the executive order requests of them? Like, how do you think about what that means for the government or what it means for the dollar or how does that fit in?
Well, the funny thing is, like, the whole Bretton Woods system was kind of the MicroStrategy trade, which is that they held gold and they issued liabilities, and then made way more liabilities in this case, and then were like, nope, that it's not redeemable for gold anymore. And that's so in some sense, holding gold and issuing currencies has always been what countries do. And even Saylor has said, I think his quote is something like, "The first country that prints currency to buy Bitcoin wins."
Yeah.
So basically, he's saying do the MicroStrategy thing on the sovereign level. Now, for the U.S. Strategic Bitcoin Reserve, my kind of stance since the election, when asked about it, is it certainly increases the odds of something like that happening compared to the prior administration, which would be near zero. And my first base case, and this is before it happened, was they were going to probably ring fence the existing assets they have, at least the portion of it that are actually potentially theirs rather than still owed to someone. And so that's kind of the low hanging fruit, is just not sell we already
Yep.
have.
Yep.
Then my assumptions from there were that I'm almost purposely ignoring it because I want my estimate for what's going to happen with Bitcoin over any sort of investment time horizon to not be reliant on what one entity does. And so my view is, regardless of whether the U.S. government ends up accumulating Bitcoin, all the conditions have been there for it, and that's played out so far. And if the U.S. government wants to buy 500,000 coins or something, that only adds to the upside thesis that I already have. I just keep erring toward conservatism in my expectations, which so far has been accurate, but we're only half a year in, so we'll see what happens the next 3.5 years of this particular term. They could, around the margins, find ways to accumulate a little bit of Bitcoin. I wouldn't over-index to it. And I paid a lot of attention to the bills that try to exclude small Bitcoin transactions from tax to assist with payment innovation. That's like an unnecessary kind of overhead that sort of suppresses innovation. It's one of the last things that governments try to do, is say, well, you can hold an asset, but you still can't use it for money without the tax man showing up at your door. So it's not easy to get things like that through. But I think it's, if anything, that's more important, is it's empower the people to use Bitcoin in all of its various capacities, more so than the government holding a big stockpile that they can choose to rug people on later. And you always have to assume that whoever owns the Bitcoin now in the government, picture your least favorite politician 10, 20 years from now, they're going to have the Bitcoin. What are they going to do with it? So I'd certainly rather see Bitcoin in the hands of the people.
Yeah, I think that's a great point, great place to end. I also counsel conservatism here on whether government's going to come. I don't think we need it at all. I think in the end, governments will probably need Bitcoin more than we need them to buy it from us. So try to stay humble and stack those sats, I think, and not and certainly don't sell your coins to the government. I know I'm not doing it. Thank you so much, Lyn Alden. I appreciate it. And check lynalden.com. She's got a bunch of her great content is there. Follow her on X at Lyn Alden Contact. And Lyn, thank you so much for coming on Galaxy Brains.
Thank you.
That's it for this week's episode of Galaxy Brains. Thank you to our guest, Lyn Alden from Lyn Alden Investment Strategies, and our friend Beimnet Abebe from Galaxy Trading. As always, everyone have a safe and happy weekend, and we will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.